Discover how massive strict REIT regulations protect your investments while creating one of Asia's most trusted REIT markets worth over $100 billion. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've produced over 600 videos with more than 280,000 watch hours as of November 2024. I also focus on regional and world economy topics. Today, we're diving into something that affects many of our investment portfolios: Singapore REIT regulations. Now, I know regulations sound boring, but stick with me, because understanding these rules could save you from making costly investment mistakes. Think of these regulations as the safety features in your HDB flat. You might not think about them daily, but they're crucial for your protection. Let's start with what keeps S-REITs stable. MAS sets a gearing limit of 45%. Think of gearing like a credit card limit. It stops REITs from borrowing too much money. They also need to maintain an interest coverage ratio of 2.5 times. In simple terms, for every dollar they need to pay in interest, they must earn at least $2.50. This keeps our REITs financially healthy. It's like having a steady job that pays more than twice your monthly loan payments. That's financial security right there. Here's something that might surprise you. Singapore has become Asia's largest REIT market outside Japan. We're talking about 42 listed REITs worth about $100 billion. That's more than twice the cost of building all our MRT lines. This massive growth didn't happen by accident. It's the result of careful regulation and oversight. The second big rule is the 90% distribution requirement. S-REITs must give unit holders at least 90% of their taxable income. This is why S-REITs offer such attractive dividends, currently averaging 6.5%. To put this in perspective, if you invested $10,000, you could receive about $650 in annual dividends. Compare that to your bank's fixed deposit rates of around 3%. This rule exists to maintain tax transparency status, which means more money in your pocket. Let's talk about property management. This is where things get interesting. MAS requires professional property management teams to be independent from REIT sponsors. Imagine if your property agent was also your landlord, and they kept pushing you to rent the most expensive unit they owned. That's the kind of conflict these rules prevent. This independence ensures decisions are made for unit holders' benefit, not sponsors. Speaking of property management, here's another crucial rule: mandatory annual valuations. Every year, independent experts must assess each property's value. These valuers must be qualified professionals registered with SISV or equivalent international bodies. It's like getting your car inspected annually, but for multi-million-dollar properties. This prevents artificial inflation of property values and ensures transparency. Want to see these rules in action? Let's look at Capital Land Mall Trust during the 2020 pandemic. While many businesses struggled, they maintained a healthy gearing ratio of 34.4%, well below the 45% limit. This financial buffer let them support struggling tenants while keeping unit holders happy. They distributed 95% of their income and kept their malls 98.6% occupied. It's like having strong insurance coverage. You might not need it every day, but it's invaluable during tough times. But let's be honest, there are some things to watch out for. Interest rates can significantly impact REITs. When rates go up, borrowing costs increase, and unit prices might drop. Think of it like your home loan. When interest rates rise, your monthly payments go up too. Also, if you invest in REITs focused on one property type, like retail or office, you're putting all your eggs in one basket. During tough times, like what we saw with office spaces during COVID, this can hurt. Here's something most people don't realize. While mass regulations make our REITs safer, they might grow slower than REITs in less regulated markets. If you invest in REITs focused on one property, it's like choosing between a safe family car and a sports car. The family car might not be as exciting, but it'll get you where you need to go safely. Understanding these regulations is crucial for another reason. They affect how REITs can raise capital. When a REIT wants to buy new properties, they need to balance debt, borrowing, with equity, issuing new units. The 45% gearing limit means they can't just keep borrowing. Sometimes they need to issue new units, which can dilute existing unit holders' ownership. It's like adding water to your coffee. You get more volume, but each sip might be less strong. Let's talk about property sector concentration. Many Singapore REITs focus on specific sectors: retail, office, industrial, or healthcare. While specialization can be good, it also means your investment is tied to that sector's performance. For example, during the pandemic, retail REITs faced challenges as shoppers stayed home, while industrial REITs serving e-commerce warehouses thrived. This is why diversification across different REIT types is important. The regulations also require REITs to hold at least 75% of their assets in income-producing properties. This means they can't just sit on empty buildings hoping for capital appreciation. They need to generate actual rental income. Think of it like renting out your spare room versus leaving it empty, hoping property prices will rise. MAS wants REITs to focus on generating steady income for investors. Let's wrap this up with 3 key takeaways. First, Singapore's REIT regulations are among the strictest in Asia, which is good for us investors. Second, these rules create stable, high-yielding investments. That 6.5% average dividend yield isn't just luck. Third, while regulations provide protection, you still need to diversify and watch market conditions. Want to learn more? Check out my video on REIT Revival. Don't miss this 2025 opportunity, where I break down the best REITs for regular income. Hit subscribe if you haven't already, and remember, smart investing is safe investing. See you in the next video. The